Global financial markets have entered a phase of severe instability, and the warning signs are no longer subtle. They are flashing in real time across currencies, commodities, and capital flows. In the early hours of trading this week, the Japanese yen surged 1.2% against the US dollar in just a few hours. An extraordinary move for a currency that has long been defined by stability and central bank control. Such a sharp appreciation is not a sign of strength born from growth, but a signal of stress often associated with capital flight, forced position unwinds, and systemic rebalancing. At the same time, the US dollar, long regarded as the world's ultimate safe haven, has lost more than 10% of its value over the past 12 months, extending its decline into the opening weeks of 2026. This erosion is not the result of a single shock, but the cumulative outcome of persistent fiscal deficits, tightening global liquidity, and a growing loss of confidence in U.S. financial stewardship. As the dollar weakens, investors are responding in the most traditional way possible, by fleeing into hard assets. Gold prices have surged to historic highs between $5,400 and $5,500 per ounce, levels that would have seemed implausible only a few years ago. This is not speculative excess, it is defensive positioning. Gold is rising not because investors expect rapid growth, but because they are pricing in systemic risk, currency debasement, and the fragility of debt-based financial structures. When a funding currency like the yen moves violently, when the dollar bleeds steadily rather than spikes during crises, and when gold breaks record after record, the message is unambiguous. Markets are no longer reacting to isolated events, they are adjusting to a world where the assumptions of stability that defined the past 4 decades no longer hold. What we are witnessing is not a temporary bout of volatility, but the early phase of a broader financial reordering. Before we go deeper into the mechanics behind this shift, who is moving the money, why it's happening now, and what it means for the dollar-based system. Welcome to GE Economy, where we deliver in-depth analysis of economics, finance, and market cycles. If you find value in this content, don't forget to like the video to support the channel, and subscribe to GE Economy to receive more high-quality insights. Building directly on the warning signals visible in currencies and gold, the next layer of risk lies deeper in a financial alliance that has quietly underpinned the global system for nearly 8 decades. Since the end of World War II, Japan has functioned as the most reliable external financier of the United States. Through persistent trade surpluses and an ultra-conservative savings culture, Japan accumulated vast pools of capital and recycled them into U.S. Treasury securities. By the early 2000s, and consistently throughout the following decades, Japan had become the largest foreign holder of U.S. government debt, at times owning over $1 trillion in treasuries. This steady demand was not symbolic, it was structural. Japanese institutions absorbed massive bond issuance, helping suppress U.S. borrowing costs and allowing Washington to finance chronic fiscal deficits at historically low interest rates. In simple terms, America's ability to spend, expand, and project power globally was reinforced by Japan's willingness to lend cheaply and patiently. For decades, this arrangement appeared unbreakable. Japan maintained near-zero interest rates at home, while capital flowed outward to higher-yielding U.S. assets, creating a stable feedback loop that benefited both sides. But the conditions that sustain this system no longer exist. Rising inflation inside Japan, shifting domestic political priorities, and increasing volatility in global bond markets have begun to strain the logic of unconditional support. What once looked like a permanent pillar of financial stability is now showing visible stress fractures. As yields in Japan start to rise and currency risks intensify, the incentive to continue underwriting U.S. debt weakens. The mechanism that kept American interest rates artificially low for generations is no longer moving in one direction. The alliance has not collapsed, but it has begun to reverse, and the consequences of that reversal are only starting to surface. As this long-standing financial partnership begins to strain, its most visible consequence is now taking shape through what analysts increasingly describe as the Great Repatriation. Japanese investors, banks, pension funds, insurers, and asset managers currently hold approximately $5 trillion in overseas assets, spanning U.S. treasuries, American equities, European bonds, and emerging market debt. For decades, this outward flow of capital was rational and profitable. Japan's domestic interest rates hovered near zero, sometimes even below it, while U.S. assets offered higher yields with minimal perceived risk. That equation has now decisively changed. In late 2025 and early 2026, yields on Japanese government bonds began rising at a pace not seen in years, while the USD JPY currency hedge costs surged, eroding returns on foreign investments. What once delivered stable carry profits now produces marginal gains or outright losses. For Japanese institutions bound by conservative risk mandates, the shift is structural, not tactical. Major banks and life insurers have publicly confirmed portfolio rebalancing toward domestic bonds, citing improved yields at home and increased volatility abroad. At the same time, declining U.S. bond prices have forced mark-to-market losses, making continued exposure to American debt increasingly unattractive. The result is a steady liquidation of overseas positions and a redirection of capital back to Tokyo. This repatriation is not speculative capital fleeing in panic. It is disciplined, institutional money responding to a new interest rate reality. Yet its impact is profound. Every dollar returned to Japan is a dollar no longer financing U.S. deficits. As this multi-trillion-dollar repositioning accelerates, it tightens global liquidity and removes a key source of external funding that had quietly stabilized American borrowing costs for generations. What appears orderly on the surface is, in reality, a historic reversal of capital flows with systemic consequences still unfolding. The catalyst that turned gradual repatriation into a structural shift came from an unlikely place: the Japanese government bond market itself. In late 2025, yields on long-dated Japanese government bonds rose by approximately 0.25 percentage points, a move that would appear trivial in most markets but amounted to a financial earthquake in Japan. For more than 2 decades, Japan's bond market had been artificially compressed by yield curve control and aggressive central bank intervention. Volatility was suppressed, returns were negligible, and investors were conditioned to look abroad. That regime began to crack as domestic inflation remained persistently above the 2% target, eroding purchasing power and triggering political backlash from households facing rising food and energy costs. Confronted with voter pressure and slowing real incomes, the Japanese government shifted course. Fiscal stimulus once again became the primary tool to stabilize the economy. Despite Japan already carrying the largest public debt burden in the developed world, approximately 230% of GDP. To fund expanded spending programs, Tokyo had little choice but to issue significantly more government bonds. As supply increased, yields were forced higher, effectively ending the era of zero-return domestic assets. This shift fundamentally altered investor incentives. For the first time in years, Japanese institutions could earn acceptable returns at home without assuming foreign currency risk or exposure to volatile overseas markets. The implications extended far beyond Japan's borders. As domestic yields climbed, capital that once flowed effortlessly into U.S. debt markets reversed direction. The United States, long accustomed to Japan acting as a silent and reliable buyer of treasuries, began losing one of its most important sources of demand. This was not a political decision, nor a coordinated financial strike. It was a mechanical outcome of rising yields and changing incentives, yet the effect is the same. With Japanese capital increasingly absorbed by domestic bond issuance, Washington faces a shrinking pool of foreign buyers. The turning point in Japan's bond market has therefore become a turning point for global finance. Capital is being pulled inward, and the system that once kept U.S. borrowing costs artificially low is quietly being dismantled from the inside. The final mechanism accelerating this reversal is the breakdown of one of the most profitable and enduring strategies in modern finance, the yen carry trade. For decades, global investors borrowed in Japanese yen at near zero interest rates and redeployed that capital into higher-yielding U.S. assets, ranging from treasury bonds to equities and credit products. As long as the yen remained weak and Japanese rates stayed suppressed, the trade functioned like a low-risk yield engine. By late 2025, the estimated size of active yen carry trade exposure had reached approximately 450 billion USD, quietly embedded across hedge funds, banks, and institutional portfolios worldwide. That stability unraveled rapidly as conditions in Japan shifted. Rising Japanese bond yields and renewed currency volatility changed the math almost overnight. When the yen began strengthening sharply, gaining more than 1% in a matter of hours during recent sessions, the cost of servicing yen-denominated liabilities surged. At the same time, higher domestic interest rates eliminated the incentive to remain leveraged abroad. What had once been a reliable source of carry income turned into a compounding loss. Investors faced a binary choice: either absorb escalating currency losses or unwind positions entirely. Unwinding meant selling U.S. assets to repay yen liabilities. As this process accelerated, it triggered a synchronized withdrawal of capital from United States markets. Treasury bonds, equities, and risk assets alike came under pressure not because of deteriorating fundamentals alone, but due to forced deleveraging. This dynamic is particularly dangerous because it feeds on itself. Yen appreciation forces selling, which tightens global liquidity, increasing volatility, and prompting further exits. The collapse of the yen carry trade is therefore not a technical footnote. It is a transmission channel. It transforms Japan's domestic policy shift into a global liquidity shock, magnifying the impact of capital repatriation and accelerating the withdrawal of support from U.S. financial markets. As the yen carry trade unwinds and Japanese capital retreats home, the United States finds itself in an increasingly passive and constrained financial position. For decades, Washington benefited from a structural advantage, a dependable foreign buyer willing to absorb massive volumes of U.S. debt, regardless of price. With Japan no longer playing that role, the adjustment burden shifts squarely onto the American system itself. To attract replacement capital, U.S. policymakers face a narrow set of options, none of them cost-free. The most direct response is higher interest rates. Yet raising yields to compete for global capital risks, tightening financial conditions across the economy, amplifying recessionary pressures at a time when public debt and private leverage are already elevated. This loss of external support exposes a deeper vulnerability, a growing liquidity and confidence gap. As foreign demand weakens, U.S. Treasury auctions become more sensitive to price, volatility rises, and borrowing costs drift upward across the yield curve. The implications extend beyond bonds, spilling into equity valuations, credit markets, and housing finance. These stresses have not gone unnoticed by policymakers. In a highly unusual move in early 2026, the Federal Reserve reportedly conducted direct inquiries into yen exchange rate conditions, an action typically reserved for moments of acute systemic concern. Such scrutiny underscores how tightly U.S. financial stability has become linked to developments in Japan. This is not a position of monetary strength. It reflects a system that has lost autonomy, increasingly reactive to foreign capital flows rather than able to dictate terms. The era in which the United States could rely on automatic external financing is fading, leaving policymakers with fewer levers and far greater downside risk. As the United States slips into a more reactive financial posture, a broader and more consequential trend is accelerating beneath the surface: de-dollarization. For much of the post-war era, the U.S. dollar functioned as a neutral reserve asset, trusted, liquid, and politically insulated. That perception has changed. Over the past decade, Washington has increasingly weaponized the dollar through financial sanctions, asset freezes, and control over global payment rails. Combined with persistent fiscal deficits exceeding 6 to 7% of GDP and a rapidly expanding public debt burden, this strategy has forced many countries to reassess the risks of over-reliance on dollar-denominated assets. Trust, once lost, is slow to recover. By 2025, 2026, the erosion has become measurable rather than theoretical. Capital flows are responding accordingly. Instead of rushing into the dollar during periods of stress, investors are reallocating toward gold, hard assets, and diversified currency blocks. Gold prices above $5,400 per ounce reflect more than inflation hedging. They signal a deliberate move away from fiat exposure. At the same time, countries with tangible resources and relatively sound balance sheets, such as Canada, have become increasingly attractive destinations for defensive capital. Parts of Europe are also regaining relevance as investors seek institutional depth without singular dependence on Washington. This shift does not imply a sudden collapse of the dollar, but it does mark the end of its uncontested dominance. Market data confirms how tightly global finance is now interconnected. According to Goldman Sachs, every 10 basis points of stress in the Japanese government bond market now translates into an increase of 2 to 3 basis points in U.S. Treasury yields. This relationship is critical. It shows that U.S. borrowing costs are no longer driven solely by domestic policy choices, but by external pressures beyond Washington's control. De-dollarization, in this context, is not ideological, it is mechanical. As confidence fragments and capital seek safety outside a single center, the global system moves steadily toward a more multipolar financial order. As the global financial system moves deeper into a multipolar phase, the next stage of this transition will be shaped by a small number of decisive milestones. The first is Japan's early general election, scheduled for August 2026. Although formally a domestic political event, its implications extend directly into global capital markets. A government mandate favoring continued fiscal stimulus would require expanded issuance of Japanese government bonds at a time when inflation remains elevated. Higher bond supply would place additional upward pressure on domestic yields, reinforcing the incentive for Japanese banks, insurers, and pension funds to keep capital at home rather than investing abroad. In practical terms, the election outcome will influence how quickly and how aggressively capital repatriation accelerates, tightening liquidity beyond Japan's borders. The second marker lies in the behavior of gold markets, which have increasingly become a barometer of systemic confidence. By mid-2026, several major financial institutions have raised their year-end projections towards $6,000 per ounce, a level reflecting expectations of persistent currency debasement and sustained sovereign borrowing. This outlook signals that investors are no longer treating gold as a short-term hedge, but as a strategic reserve asset. The combination of rising political risk, higher global yields, and shrinking trust in fiat stability has shifted capital toward assets that sit outside the debt-based system. Together, these two milestones point to a compressed timeline. The second half of 2026 may not trigger a sudden rupture, but it is likely to define the pace at which markets reposition for a world where financial resilience matters more than yield. In the final analysis, it is crucial to separate intent from outcome. Japan is not launching a financial attack on United States. There is no declaration, no coordinated confrontation, and no attempt to destabilize global markets. Japan is simply doing what every rational nation ultimately does when domestic stability is at risk, bringing its capital back home. Yet, the consequence of this decision is far from neutral. By reversing decades of outward investment, Japan is withdrawing one of the most critical pillars that supported the U.S. debt-based financial system. For generations, American deficits were financed cheaply because trusted foreign creditors, above all Japan, were willing to absorb U.S. Treasury issuance almost without condition. That era is now ending. As Japanese capital is redirected inward, the United States loses its most patient and reliable external buyer. Borrowing costs rise, financial flexibility narrows, and policy trade-offs become sharper. This shift does not imply an immediate collapse of the dollar or a sudden global crisis. Instead, it signals something more structural, the slow but irreversible erosion of a system in which the world subsidized U.S. borrowing. In its place, a multipolar financial order is emerging, one defined by fragmented capital flows, higher risk premiums, and a renewed focus on real assets and domestic resilience. This transition will not unfold overnight, but it is already underway and cannot be undone. Thank you for watching the video. If you see these dynamics differently or hold an alternative view, feel free to share your perspective in the comments below.